Your financial life is more integrated than you can possibly fathom. For example, one small move in your investments, one innocent move, maybe even at the advice of your investment advisor, could throw your taxes into chaos. I've got a real life planning scenario, what you need to look out for and the right approach to take instead. I've got that and more coming up. We've seen some nasty capital gain distributions this year from actively managed mutual funds. And I'm recording this right now, early April in 2026. So technically we're still in tax season, but we're past the peak of it. And so one of the trends, and we've seen this, is more people are using exchange traded funds or passive funds for their non-retirement investment account. So not in their 401k, their IRA. This is just an individual account, a joint account, a brokerage account. Okay, so more people are using exchange traded funds or passive, index type funds. However, those that are still holding very, very active funds, we're seeing a significant increase in the amount of capital gain distributions wreaking havoc on people's tax returns. And we warned you of this. This is a known issue, and the way the investment year was shaping up in 2025, this was a high likelihood. So here's how this works. If you are investing inside of your 401k, your IRA, your Roth IRA, your HSA even, those are all different types of tax shelters, which means, on your contribution, you may get a tax deduction. On the withdrawal, it may come out taxable, may come out tax-free, but inside the account, it's tax sheltered. All the capital gains, all the dividends, all the interest, it doesn't land on your tax return. And while that doesn't make the headlines, that doesn't seem like that big a deal. Oh, it's a big deal because it doesn't mess up your it doesn't create financial surprises or tax surprises. Let me say that. That's your tax shelters. Well, what if you have dollars that you've saved up in just an individual account outside of your 401k, outside of your Roth? This makes a lot of sense. Maybe when your income has reached a point where you're max funding all those things, but you still want to be saving aggressively. Yep, love that. Maybe if you receive an inheritance, you receive some sort of buyout. Maybe you sell a property, something like that. There's a lot of reasons why you might have some dollars outside of tax shelters. Well, then, because they're not in tax shelters, those capital gains, the interest, the dividends, they all land on your tax return. So you need to be very, very careful. Well, mutual funds, exchange traded funds can do this too, but oftentimes exchange traded funds are managed in such a way that they avoid this. So Benefit Exchange Traded Funds did a video about that just recently. But mutual funds, it's possible that even though you hold that mutual fund throughout the entire year, you don't sell anything, it's possible capital gains will land on your tax return without you doing anything. You didn't sell anything, but you've got to pay some capital gains by surprise. This happens because within the mutual fund, the manager or management team, they are buying and selling individual stocks. And they may have bought NVIDIA way back when and sold some of it last year. Well, if they did, you're not going to know. They didn't ask you. They didn't send you an announcement. And they certainly didn't tell you, hey, watch out, there could be this big tax benefit. But obviously, NVIDIA has had a huge run up. And if they sell some of that or any stock or any investment that has had a run up, the mutual fund doesn't pay taxes. The shareholders do. So they pass along those taxes to the shareholders via these capital gain distributions. And because the stock market performed the way that it did in 2023, 24, and 2025 with the level that the stock market was at, it just seemed likely that more and more actively managed mutual funds were going to be passing along these capital gains. Well, that happened a ton this year in a recent real life planning scenario. I'm changing some of the details because it's all confidential. But recently we were meeting with an individual where the only thing we do is prepare their taxes. And we've been preparing their taxes for a long time. They have an investment advisor at a company that's actually very, very well known for just doing passive investments, but they have an active investment with that company and they work with this investment advisor. And we've told them along the way, hey, I'd probably make this change. No, we're okay. Okay, that's all good. Well, they've had a lot of capital gain distributions land on their tax return over the years, and it's created an enormous surprise and a big headache for them. Well, this year, yes, there was a big capital gain distribution, but there was also a very big realized capital gain. Such a big realized capital gain that it pushed them out of some of the tax deductions that they otherwise would have been eligible for, and it created an enormous tax bill, an enormous tax surprise. Sadly, the investment professional told them, hey, if you're frustrated by these capital gain distributions that you continue to get, let's start selling some of the investment and we'll reinvest it into a CD, and therefore you'll know what the interest is. That advice was not connected to their taxes at all, and obviously it was rooted in a tax surprise that this individual, this client, was frustrated about receiving. You would think that there would have been some discussion about, well, what's the taxable impact of selling some of this investment? And then if it still makes sense to do it, how much capital gain should we realize so that we don't miss out on some other tax benefits? That planning, that forethought never happened. And when we sat down with them, there were a few things that were triggered because of the lack of tax planning. First, without these capital gains, without the realized capital gains, they were just below the IRMAA threshold. And IRMAA is income-related monthly adjustment amount. It means that when you are on Medicare, Part B and Part D, what you pay for your Medicare is actually connected to what your income was, modified adjusted gross income, from 2 years ago. Okay, and if it's too high, if you make too much money from 2 years ago, then what you're going to pay for your Medicare this year is going to be higher. You're going to have a surcharge. Well, this blew right through that threshold. Really is likely going to put them into the third tier, where they're going to pay more than double for their Medicare 2 years out from now than they would have otherwise. So there was no consideration of IRMAA, and it's going to create an enormous tax surprise. We had to tell them that. And then second, speaking of enormous tax surprise, they were going to be getting the full state and local tax deduction on their itemized deductions. They are charitable and they do a lot of other things, and therefore it was going to be best for them to itemize their taxes. Because of the changing tax laws, the state and local tax, the portion of the itemized deductions that cover and allow you to deduct your state and local taxes, property taxes, that sort of thing, it used to be capped at 10 grand. Well, if your income, modified adjusted gross income, is below $500,000, then you actually get a state and local tax deduction up to 40 grand. It's capped at 40 grand. But if your income, adjusted gross income, goes above $500,000, then 30% of every dollar over that creates a deduction of the SALT cap. And it goes from that 40 grand of SALT cap down to 10 grand if your income is above 500,000 all the way up to 600,000. So that $100,000 of extra income is an effective tax rate of over 45%. And therefore, they call that the SALT tax torpedo. They sold so much of this investment that it blew right through the tax torpedo. It put their adjusted gross income, modified adjusted gross income, just above 600,000. It was almost like the planning was to get the least amount of tax deduction possible. And that was by accident, because if you were planning, you would have avoided that altogether. But it created an enormous tax surprise because they lost out on $30,000 of deduction just by that lack of planning alone. So what's the takeaway? Your financial life is made up of 6 different areas, but even though they're different areas, they do overlap and intersect. You need a comprehensive financial planning approach. We call it one plan, where you're looking at all 6 areas when you're making big financial decisions. To me, it seems wildly obvious that an investment professional that is telling someone to buy or sell or make trades inside of an individual brokerage account, one that's not a tax shelter, they need to be very sensitive to what the potential tax consequences are. Not everyone takes that approach. Just like not everyone, where they're giving advice on your home and auto insurance coverage or deductibles, is looking at your net worth or the rest of your financial life when giving that advice. But that's what you need. Those 6 different areas of your financial life are actually connected. You need to be working with a certified financial planner who's looking at all 6 of those areas and can give great guidance so that you can bring synergy and certainly avoid surprises when making key financial decisions. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.